I'm not going to go and buy an investment property. I'm just not going to do it. I'm too good at this shit, so why would I do that? Like, it's like asking Lance Armstrong to go and do a running race. Like, it's stupid. You know, like, it doesn't make any sense.
The Australian stock market has reached
a 1-year high 135 times in the last 10 years.
Wow. How big can your fund or strategy get before you would like soft close or something like that?
I mean, it's a zero fee product. So like if we don't generate positive returns above the RBA cash rate, we don't get paid.
Got a question that's been sent in, so I'll just play that now.
Two Domes and the Doc. My name's Tiptoe Tommy.
The Doc's not here today.
Who's the Doc?
Drew. The mighty Luke Laretive, how you going, mate?
Hey, Rasky, how are you?
Good. Drew's in Shepparton today, so he couldn't join us.
Robbing grandmas in country Victoria.
Yeah, he is. Yeah,
got it.
But no, he's he was disappointed that he couldn't be here. He sent me a message yesterday saying something on the lines of, "Well, I've got to do a podcast with Luke soon." Oh,
well, yeah. I think if Drew's going to be here, I'm going to need a alcoholic beverage to get through that. So
today we'll be going through his portfolio in his absence anyway. So feel free to be as brutal as you want. And then we'll also answer some questions. I did get some questions sent in via the community, via the link that's available in the podcast players, YouTube players in the description. But also, I did get some voice messages sent in. So I just wanted to get your your 2 cents on that. Actually, there was a question which I might jump straight to, Luke. And this one comes from Jeno. There was a bit of autocorrect going on in the texty here because some people could have texted me.
So what, they text you?
Yeah, I put my work number. I've got eSIM on the iPhone. I put my work number out there on the ether and just saw what happened.
Idiot.
I know.
That was a really bad decision.
But this was a good one. Hi all, if you're investing now, would you go for NVIDIA? And they spelt it INVIDIA.
Yeah, going beautifully.
So I'm not sure if it's India or NVIDIA.
Yeah, got it. Yeah.
Or Prometheus.
Yeah, good. Very look. If you can't spell them, don't buy them. That's my tip. If you want a quick shortcut.
Okay, NVIDIA or Pro Medicus?
Okay, so I'm not I no longer am responsible for doing any, direct global share picking.
Yep.
So I'm not an expert on NVIDIA.
Yep.
But I'd argue that it's probably one of, if not the most analysed, efficiently priced securities on the planet.
Yeah.
It's got 70 analysts who cover it professionally, highly paid, smart, CFA qualified people covering that stock every day. It's got I had a quick look before I came. Stock's trading at 171 last night. Consensus price target 179. Bulls are at 200. Bears are at 150.
Right.
I mean,
split the difference.
What else do you want to know?
Yeah,
it's efficiently priced. There's not a lot of opportunity there for outperformance or edge, in my opinion. And why would anyone think there is? You would think that any information that is known or could be known is going to be relatively, on a probability weighted basis, priced in the price, priced efficiently into the price every day. So, am I particularly interested in NVIDIA as a holding? No, because I wouldn't think there's a lot of alpha there.
Okay.
PME is in my investment universe, and I do have to cover it. Last trade was at 328. Bulls are at 350 for the analysts. Bears are at 225. Consensus at 310. 12 analysts. So also by Australian standard, that's quite well covered. About as well covered as like CBA, for example, right? So it's not like this stock's unknown or there's not smart people out there looking at this every day. Our views haven't changed really on Pro Medicus. We were on Livewire. Ben covered it. I covered it. People always want to ask us about it for some reason. I think because we're sort of semi-bearish on it.
You semi-bearish from the business, from the valuation standpoint?
Yeah. I mean, it's a good business. It's a great business, arguably. And it's trading just at obscene multiple. So, our job as fund managers isn't to buy good businesses, believe it or not. Our job's to buy good undervalued businesses and then watch those undervalued businesses become fairly valued or hopefully overvalued, and then we sell them.
Yeah.
So when a business is priced like that, it's priced for nothing to go wrong. Anyone who's ever been in business knows something can always go wrong, regardless of sort of how bulletproof you think they are. And sort of we're sensible to know that and assume that at all times. And things do often go wrong, expected or unexpected. Even if that wrong is simply the market over extrapolating the current growth rates or the current contract wins, or getting too far ahead of, what's realistic for them. And, nothing in our view makes a stock go up more than apparent certainty, and nothing makes a stock go down faster and harder than that apparent certainty becoming uncertainty.
Interesting. Yeah.
So,
a good thing that just ain't so to speak.
Yeah. So, nothing is that certain that you need to pay that much for it. Sometimes the market's pricing in a perfect future and perfection occurs, in which case often you can make money owning those perfect investments. But our process, like any investment process, isn't designed to capture every single opportunity in the market. No process is, and it's no one's perfect. Our process clearly works, but PME doesn't really fit into the kind of investing that we like to do, and that we think if we did 100 PMEs, we don't think we'd outperform.
Yeah, okay.
So, not saying that PMEs are even going to outperform. We might be wrong. Probably are. Who knows? But I'm not going to breach my process and go chasing PME. I'm going to just keep following my process, keep throwing up ideas that aren't Pro Medicus, and we'll keep buying other stuff.
You know what? It's actually funny talking about process because we've had a lot of people talking about you lately. Terrible things, of course.
I was going to say.
No, but we have had a lot of community members talking about like the way you invest. You've talked about some companies who've been here on the show as well, but also last time we caught up, Good Research obviously sold out, which is the membership subscription side of what you do. You've got the fund and the portfolios and all that sort of stuff that you run. But I guess one of the questions that is like you guys are like punching up in the league tables as well as a whole, like across the whole country. Like, what would you say to people? Okay, I'm gonna play devil's advocate, right?
Yeah, do it.
I want to invest with Luke, but I'm worried I'm investing at the top of the market.
Well, it's not the top of the market is the easiest thing to start with. So, do you know how many weeks or how many 52-week highs we've had on the market, in the Australian market, in the last 10 years?
Well, you told me to answer this before off air, and I got it so goddamn wrong that I'm not going to even shame myself on the show. So
it's
tell me.
135 52-week highs.
So the stock market, the Australian stock market has reached
a 1 year high, a 52-week high, a 1 year high, 135 times in the last 10 years.
Wow.
So,
wow.
Yeah, and if you look at, say, like the small cap index and the small cap active manager peer group, bull markets in small caps have lasted sort of 4 to 7 years historically, and we've kind of had 18 months so far of bull markets. The first 3 or 4 or 5 months of Seneca small cap, it wasn't a bull market, and you can go back and have a look at the data. So can we keep going? Can we keep making good returns? Well, last 12 months we did 26% for the year, financial year, and we beat our index and the peer group, which are about the same, at 13.65%, or by 13.65%. And over the long run, if you have a look at active managers and index returns, active managers, discrete years for the last 10 years, maybe 20 years. I can't remember what I ran this data on. I think it was 20 years actually. Active managers, the peer group active managers have done 11.19% per annum on average in discrete calendar years.
11.19.
Yep. And then so any given year that will be different, but on average it's 11.19. And then they've outperformed the index by 3.7% in the smaller part of the market. So the conclusion kind of here, and I suppose that this is a long way of saying, smalls can easily keep running as a cohort for the next 24 or 36 months, no problems. Okay. You don't have to worry about the cycle. I think the cycle looks good. The average active manager in those markets is beating the benchmark by almost 4%. And in the last 2 years, since we've been running our strategy, that pretty much holds. I think it was about 3% the last couple of years, the average active manager in our space. And Seneca's been 4 to 5 times better in returns than that average active manager so far. So do I think that, and I've sent you the data for this so you can, I'll
see if I can bring it up.
You can go and have a look at it if you guys want to have a look at it. But I've got the file as well. Like I can flick to you. But the long story short here is what is that? 2005. So 20 years I did this data on. So I would be pretty confident that we can keep having positive absolute returns for the next few years, and I'm pretty confident that we can be among one of the best in our peer group. Among the top few in our peer group. And if we can do that, we hopefully can keep beating index by, 5 to 15% per annum, which would be, a really good outcome.
A few weeks ago, I asked you a similar question when we were just catching up. How big can your fund or strategy get before you would like soft close or something like that? So because you want to maintain that nimble, because you want to earn performance fees, you're incentivized to make really good returns. You're not like most fund managers that will just keep growing into infinity and justify. You want to make good money.
Yeah. I mean, it's a zero fee product. So like if we don't generate positive returns above the RBA cash rate, we don't get paid. So I think in answer to your question, I think you would have to think about hard closing it at like, if you look across the peer group where everyone else is hard closed and whatever, what other successful managers have done over the journey, probably $750 million or maybe even up to $1 billion. But I would say it's in that high from 750 plus. Mm-hmm. Not many do well from $1 billion forward.
And by that we mean when Luke would no longer accept new money into the strategy because it would be too hard.
It'd be like a hard close, no more money. A soft close is when you say, okay, anyone who's invested in the product can keep putting money in, but no new people. I think that would be in that 300 to 500 range. Mm-hmm. And it would depend on the kind of companies we're investing in at that time, how the strategy's evolved, how many people are invested in the strategy. Because, if you've got like big clients invested in the strategy and they're going to be throwing more money at it over the next, as the years go on, you might soft close earlier.
Yeah.
If you've got a bunch of small clients in there who don't have a lot more money to throw at the strategy, we might be able to keep it a bit too long. But, we're always going to be at that point where we want to leave at least 100% gain for the fund on the table. And if you think about, doubling time is 8 years, well, that would give us like, on our view for 10%, doubling time, 8 years for 10%, we could do 20% returns for 4 years. So that's sort of,
roundabout ways
to kind of think about it.
Yeah.
I mean, we don't worry about it. We're at $12 million in farm. Mm. So we're just trying to grow it to 100 and we'll worry about these problems later. They're not problems for today. But, if some of these big institutional investors who we've been talking to are as keen as investing with us as they're saying they are, we won't be available for people to invest with forever.
Yeah. Just coming back to this chart you just came in with, for people that are listening, we can walk through it. But I don't think I've seen 20 years of data of active versus passive in small caps like this. It's really cool. So
I got this from FE Analytics, which is, I think, the best data set available.
All right. FE Analytics.
FE Analytics, Financial Express Analytics.
Just for small caps or for everything?
Everything, like all fund manager data, I think it's the best product.
Oh, okay.
On aggregate, like I'd use that over Lonsec any other week. Like,
oh, really?
No disrespect to Lonsec, but FE's better.
Yeah.
Sorry if they're an advertiser or whatever. No. It's just my professional opinion.
So they're not, but that's all right.
They just should be. Owen could edit that out for you, Lonsec, if you were paying him $60,000 a month.
But I wouldn't. But anyway,
well, come on.
Maybe $60,000.
$60,000 a month.
Yeah, 60. Yeah. So that actually, I've never. Cause the reason I've seen like 5-year data and stuff, but that's actually like we know the small caps active.
I get that back to the data set goes back to 1989.
Oh wow!
I just pulled. I mean, I did this in 3 seconds. Like I just ripped it up for you.
I would love if you could send that, and then after the fact, we could pop it on the screen for people that are watching after the fact.
I'll do that for you. I'll ask. Whatever you ask, I'll do.
So, because that is so compelling, though. Look at that. Like some of those years, like 2012.
I was a Peroni, and I come in here and
you get a water.
You're asking me to go back and do more work. Yeah, this is ridiculous.
2012, 2013, 2014, 2015, the index did bugger all, and the active peer group was like
Yeah.
Way up.
Yeah.
Anyway, I just think that's like the interesting. So, okay.
Forget about active versus passive in smalls. It's don't even worry about it. It's a stupid argument that any more podcast time spent talking about active versus passive in Australian small caps is null and void. Forget about it. It's over. You don't use ETFs. Don't use index funds in small caps. The end.
Amen.
Nothing to talk about.
Amen. Okay, so there was a question sent through. Let me just get this up. This was from, who was this from? Something like, the self-taught company secretary. Because we had a bit of a yarn about Kelly Partners the other day, being the accounting firm, KPG. Self-taught company secretary corrected me on something. It's a whole bit of a mumbo-jumbo about, Kelly Partners basically looked like, in my opinion, they looked like they issued about 374,000 shares. I didn't know who that was to. It turns out it was to the operating partners within the network of Kelly Accounting Partners to invest in the company and further share in the long-term growth of the business.
Yeah.
This is the first capital raising. Anyway, I just thought, because when they originally did their update, it was not clear to me. But that was just my 2 cents and someone's corrected me on that. So I stand corrected. My question to you is, do you know much about Kelly Partners, KPG? Do you own it? Do you like it? Do you not like it? What would be your 2 cents?
We don't own it. Look, it's just a pretty bog standard sort of debt-fueled, acquisition-driven professional services company. We've seen it plenty of times in listed environment before. Accounting as a business is I think this thing's growing at like 3s and 4% per annum revenue growth, organic revenue growth, I should say. So let's generously call it a low single digit to mid single digit type business. And, they're fueling higher returns through, currently at last financial results, $61 million in debt.
Yeah, right.
Okay, so this thing's on 353% debt to equity. So all your return on metrics, and this is why I think, you've been big on, return on invested capital, teaching people about ROEs and ROICs and ROAs and all that jazz. But the reality is that anyone can make those look good, same as you can with a property, same as private equity do it. It's the same here. You can do it with a company operating leverage, is that you use debt to make those numbers multiples bigger of what they actually are, in practice. And if you look at the return on assets versus the return on equity, you can see there's a huge disparity. How does that work? Well, it's because of the debt, right? So I just see this sector as pretty boring, and there's 10 or whatever, 15 mid-market accounting firms in Australia who are doing 100 to 500 mil revenue. They all have the same strategy. They all want to go out and buy accounting firms doing $5 to $50 million in revenue and roll them up. And they've got this roll-up strategy. They've all got access to the same cost of capital, essentially, same cost of debt. And they're also competing with private equity firms who are also doing these professional services roll-ups.
Yeah.
So I don't really see how this doesn't end in tears. I don't know when this ends in tears, but the music will stop here, where businesses will stop. They'll make these acquisitions and they'll be accretive. And just like in a private equity vehicle, the first class of private equity investments are generally better than the second class, and the second class is better than the third class. And then when the amazing track record's there and everyone's piling into it, they're buying the lowest quality investments that investment team's ever invested in. Yeah. And it's the same here,
so eventually the number of good accounting firms will just dry up.
And you have to keep growing, keep feeding the beast, because you're on 17 times EV to EBITDA.
Yeah.
And so at the moment, they're just playing the game. You're trading, your equity's valued at 17 times. You can buy practice on 4 to 7 times and add the earnings in, use debt to pay for it, all accretive to shareholders. And while the debt's manageable, which it's not overly indebted, as much as the 353 sounds big, it's not actually that big of a deal. It's well and truly covered from cash flow. And this is a pretty well managed business by by all reports, and certainly by the numbers. But I wouldn't get sucked in here by a 47% reported ROE or the quotes that I was having a look at that are in the management preso, which were a bit strange to me. All the acquisitions always look great. when you whack the earnings in, you haven't had to issue shares to buy those earnings, and the company just looks like it's going up and to the right. But that's at T0.
Yeah.
What happens at T4, T5, T6? That's when the music stops, and we decide whether these acquisitions were actually worth the 4 or 5 times we paid for them, and whether actually we're going to get our money back over. We got our money back over 4 years, or we got it back over 15.
You know, like so like G8 Education, ASX, GEM. I often think about a business like that, and I often think they're like be there for a good time, not a long time. Mm-hmm. Is that an instance like you think this might play out? Like eventually the return on every metric that you look at returns to what should be the natural economics of this business? Because like we can see here on the screen in front of us, that's return on capital, which is debt and equity.
Yeah. So
and that's been
look,
weaker the last 3 years, which whatever.
Don't know. Well, you know, look, all I'm saying here is that the number of firms trying to buy the same shit at the same price using the same capital is too high. So the quality of the acquisitions, there's not that many good accounting firms out there you can buy. It's going to be a fragmented industry, but they're going to be all competing.
Yeah.
And if I was selling my practice, I know what I'd be doing. I'd be talking all 10 of them.
Yeah.
So I would just argue that it might not be today, it might not be tomorrow, but I was thinking about another company that did a sort of similar, remember City Chic, CCX?
Yeah.
Pull up a CCX 10-year share price chart for me.
ASX, CCX coming right up. Google Finance, which is the Lord.
Yeah, you know I hate that thing.
Oh my.
Right? So that got to $6.
They went from people listening, that went from 16 cents in 2018 to
$6.
Yeah. 2021, and now it's back to 8.5 cents.
Okay, so look,
wow, what a round trip.
Not the same story, right? No, and I'm not trying to compare. It's not the same. However, this was like a store rollout story.
Yeah.
And then it all went to hell in a handbasket, as you can probably tell. So this is where, you know, you're not making acquisitions, but you're funding growth of rolling these stores out geographic locations. It's kind of the same. You know, you're buying these accounting practices, increasing the geographic footprint, you know, getting the synergies, blah, blah, blah.
Yep.
So this is when it goes bad. This is what can happen. And I mean, everyone remembers Slater and Gordon.
How can we forget that?
I just think professional services on the ASX fucking sucks, man. Like I just think you don't want to be there. This seems to be going okay. They seem to be managed. Kelly Partners seems to be going okay. They seem to be managing it okay. Probably worse things you can own. But, yeah, it's not really the kind of thing it definitely doesn't fit the kind of investing that we like to do at Seneca.
Okay. Let's switch gears a bit. You're building a house on the rocks. Am I
where are you building a house?
Aren't you?
No, I bought a house.
Oh, you bought a house?
Yeah, I bought a house in Belbrae, Torquay.
Cliff tops.
No, it's on the cliffs. No, it's in the. Anyway, but yeah, what's
overlooking the mighty Bells Beach. I've got a question that's been sent in, so I'll just play that now. See if I can get it to come through on the old switching device. Here we go.
Two Domes and the Doc.
Doc's not here today.
My name's Tiptoe Tommy.
True.
First time caller, long time listener. My question for you three. The better performance over the next 5 to 10 years, where will it be? The property market or the share market?
That's it. That's from Tommy.
Yeah, well,
property market or the share market?
Depends what you buy, doesn't it?
Well, if you're laying down your clams.
Oh, well, I mean the share market.
Yeah. 100%.
It's not even hard. Like
why?
Not even hard. Because you're talking the only thing that makes property returns good is gearing. Mm-hmm. So we talk about gearing in Kelly Partners and how it drives up return on capital. Mm-hmm. Property returns are the same. You put $100,000 down to buy a $500,000 house. Mm-hmm. The house goes up by $100,000. Mm-hmm. That's a 20% gain on the house. Let's say over 10 years or whatever. But 100% gain on the capital that you put in because you've used debt to juice your returns. So, look, I don't think it's really even. I think that question well, you talk about my money. It's kind of dumb because I don't invest in property.
Other than the one that you live in.
I just bought a house like to live in.
Yeah.
So
any excess capital,
but I'll never sell that house.
I'll
just live there forever. So
look at like young Warren Buffett.
Huh? Yeah, I might knock it over and build something nicer. But like that's the point. The point is that it's not. I don't own that house for the investment. I own it because I want to go surf Bells Beach and play golf and live in a nice spot.
Yeah.
You know, so I don't I'm not a property investor. Never have been. Never owned a property in my life. This is the first house I've ever bought. So, you know, the idea is to invest in companies that can generate higher returns on capital than you can, and ideally continue to drive those returns on capital up year after year. So, you know, if we can do that in a portfolio in a diversified way, we're not going to be wasting our time, you know, buying fucking apartments off the plan from Lendlease or some shit. Like, it's not, you know, you know, to me, I don't know. Like, people always talk about like, what do I care? I'm not going to go and buy an investment property. I'm just not going to do it. I'm too good at this shit. So why would I do that? Like, it's like asking Lance Armstrong to go and fucking do a running race. Like, it's stupid. You know, like it doesn't make any sense.
Okay. You know? I got another question sent in. This was, I asked for people to send me voicemail. So this is one I just thought I'd get your opinion on.
Here we go. Yeah.
Okay. It's not coming through. Here we go. Let's go this way.
That's a Chinese spy. They're always coming after me as well.
There's actually Twiggy Forrest's secretary calling through to say, what do you think of Fortescue?
What do I think of Fortescue?
Would you buy Fortescue?
No, we don't own it. It's just an iron ore warrant. It's an iron ore warrant.
Do you think its best days is behind it?
No. I just think it's just a big hole in the ground that goes to a port and sells shit to China, makes steel with it. Like, it's not steady state business. Iron ore price goes up, Fortescue goes up. Iron ore price goes down, Fortescue goes down. Pretty simple. I think there is, you know, there's probably other ways to play iron ore for my personal preferences. I think Fortescue kind of lost their way a bit. Now they're trying to get back on.
Well, with the future industries thing?
Yeah, future industries and, you know, green hydrogen and blah, 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 blah. So, you know, I don't think they're necessarily the best use of shareholder capital. I think if Twiggy wants to do those things, he's got plenty of money of his own to do that with, not with shareholder money. But I think he's had there's been plenty of, you know, nobody needs me to be putting another boot into Fortescue and whatever. There's plenty of people with a lot more money invested in Fortescue and a lot more right to complain about it than me. We don't own it, and we're pretty constructive on iron ore stocks at these prices. I think it's kind of bottom of the cycle type stuff. I'm not sure when it turns, but probably the only iron ore exposure that we've got specifically is really like the royalty stuff through Red Hill.
What's that? Red Hill?
Red Hill Minerals, RHI. They've got a royalty, as you know, Benny and I are big on royalties, specifically mining royalties, and they have a royalty over the Onslow Iron Ore project, which is the MinRes haul road thing that they've been doing. That's ramping up to 30 million tonnes per annum, which will be a shitload of cash for those guys.
Okay, cool. Got one more question before I get you to rip apart our portfolios. There's a question that was sent through PlaySide, and the question was actually a really good one. I'll just get up. PlaySide is a business that I'm familiar with from a few years ago. Dear Mr. Rask and our Lord and Saviour Andrew Derrimouth, rest in peace, he's not here today. I have a question about our friends' conduct over at PlaySide Studios. That's ASX PLY. They say, over the course of the last year, there has been some announcements that I, and I feel like other investors too, have concerns with. Can I please get your thoughts on management sales of stock immediately prior to the announcement, which tanked the share price? And then they said, ... give her brother a heads up next time before you tank the share price. Then there was another question to this, which is the out-of-the-blue resignation of Jerry Sackers, who was the co-founder and even perhaps the face of the business with little or no notice. And the third thing they said, a significant restructuring after an unexpected delay in ongoing work contracts. Any explanation? So this is PlaySide Studios. PLY is a ticker symbol. Luke, what do you follow the business? Do you know much about it? What do you know?
Loosely.
Okay.
So sorry, I'm not talking to the microphone. None of those things sound good if take them at face value. I don't follow, the ins and outs of this too well. We read about it, we follow it a bit, but I don't necessarily think this guy's, what's his name, who's put this in?
The author of the question is a sheep to be shepherded.
All right, sheep. The sheep is, look, I'm sure he's pissed off about all this stuff, and I'm sure that's all true and, correct, but what do you do from here is probably a better question. Stock's down heaps, right?
Yep.
So on my numbers, the numbers I've got for this, I sort of think they can probably get to positive free cash flow if they can hit these cost out plans and these new games they're launching. They've got this mouse game and they've got this Dumb Ways to Die game coming out.
Oh yeah.
Apparently they're big, they're going to be hits. Now, if they can do the cost out and they hit, I reckon they can get to positive free cash flow FY26. So if that plays out, it's probably on like 7 times EV to EBITDA, and it looks okay. If that starts to play out, I mean, I think you're going to get diluted between now and then. They're going to only have $10 million in cash. So I mean, they've got to raise.
Bit of a capital raise, okay.
Yeah, and the stock's up 35% last 30 days, I think. So so 14 to 20 roughly. So I don't know why they wouldn't just do a raise now and lock that in. So, if you think that this management team for the first time in history can actually execute and deliver on what they said they're going to do from a profits perspective and from a cash flow perspective, it might be a good bottom fish opportunity. I've got no evidence to suggest that that's going to be the case.
Okay.
I've never been able to do it before. So... I'm not massively hot on this stock from what they do perspective.
For people that aren't familiar, PlaySide Studios creates mobile games. They had out of COVID. I actually held the stock for a while, and out of COVID, they have the Dumb Ways to Die franchise, which being a Victorian, you might have seen this around about 10 or 15 years ago. You saw they look like little beans, little characters. And
I never played it, but I know of it.
Yeah. So that was always shown on the site. That was actually created for the train system here. To Dumb Ways to Die is like trying to encourage safety in an ironic twist. And they actually bought the IP rights to them and then floated them all as NFTs.
Yes.
I'm the lucky owner of one of those NFTs.
Oh my God, Owen, you are a moron.
And I lost, not only did I lose all of my money that I put in, like it actually went down like 95%, but I also lost my OpenSea account. So then all my NFTs went as well.
And you've just lost your dignity on
I've done that a few times.
Radio. So all credibility has been thrown out the window. No,
but,
anyway.
But they we had Jerry Sackers on the show many years ago. If these games can work, they're great. They're kind of like wonderful
license
IP. Yeah. But they also balance that with what they call work for hire, which is
stuffed them.
Yeah,
essentially they've lost all that. They've had to downsize the business. I think
when they expanded into Queensland and they bought all these developers in, I was like, that's a lot.
I think that they had to cut. They had to sack like a third of the workforce.
Yeah, it's hard.
So they're in a big kind of inflection point here. It either goes well or it don't go well.
Yeah.
So I can't see these guys getting a second chance. If I was managing that business, I would be hitting up my investment banker today, being like, get me in Holt, go and get me $15 million.
Right.
Because if these games don't hit, could be in a real pickle. So not the kind of thing we do at Seneca. Haven't done it, haven't ever owned it, not that interested in owning it. Not that interested in punting on the management team executing because, they haven't been able to do it so far.
Okay.
And I don't know them well enough to be able to be like, those guys are going to be able to do it. So
fair enough.
we wouldn't be there. If you're already there and you do like the business and the set, and you know more about it than I do probably, and you want to be the sheep, go for it. Whatever you want to do, it's your money. But I wouldn't put my money into this.
Okay, bit too binary.
Even at current prices. Bit binary, and my bias on the binary is to the downside.
Yep.
So my gut feeling tells me this will be another example of promise and under-deliver. And I think if they did deliver, and it was that there was some evidence there and we got constructive on it, it's the kind of stock that's going to give you a chance because so many people have lost so much money in it over the journey. They're going to see the chance to get to recoup some of those and they're going to want to fill it in. And they might be willing to sell it to you indiscriminately.
That's a good point. Management selling stock
even at a high price,
prior to an announcement is not good. Just generally speaking, there's normally blackout windows and that sort of stuff on trading.
Yeah, I mean, look,
we don't know the full context.
I don't know. I didn't bother, I didn't get the question, so I didn't really spend a heap of time on it. I just looked at the stock name. So I would be very a lot of retail investors over complain to me about management behaviour sometimes, and what they're really complaining about is losing money.
Yeah.
So it's not a big bad conspiracy out there. Sometimes it is, sometimes it's not, or most of the time it's not. So I don't know the specifics here, so I can't really comment. But I'd be, just be careful when you're trying to say people are doing shit and insider trading, because it's a pretty serious accusation. So I wouldn't be making that. And if it is that obvious, ASX going to whack them, right? So
true.
We'll see.
And I would, having met Joe before, I would suggest that is not the case as well, because I got none of that impression when I spoke to him. So,
but you think I'm a good bloke, and that's not true. So
yes. Yeah, you might not
be the best judge in character. You always have me on here. So
what you're about to say next might influence that. So we've got three portfolios. We've got three portfolios, one community portfolio here on the screen in front of you, Luke. We've been running these $10,000 fake money portfolios, just purely a bit of fun. Dizzy Rascals is a community portfolio. This is the best one. Is yours truly, named it by Monique, and everything is from Drew, and that's winning the pack at 7%. 4.5% for myself and 4.6% for the community portfolio. Now,
we've done 30% after fees over this same 6-month period. Drew's been able to get 7. Is that what you're trying to tell me?
Yeah.
Yeah.
Have you done 30% this year?
I don't know what we've done this. We've done a lot this year. This last 6 months, we've done a lot.
Wow.
So anyway, I'd have to check the data for you, but it would be big.
So Drew's only anchor in his portfolio, he's got PME, is Tesla down 24%. It is like Munro and Dion Hirsch.
Wasting his time.
Yeah, okay. Microsoft, NVIDIA, which you just mentioned. What the hell's... Cura is the resources ETF. He's got ResMed in there for a small exposure. Thoughts on this portfolio?
Yeah, I mean, I asked you before and I'll ask you again for the benefit of the listeners. Is the goal of this portfolio to make the most money humanly possible? Or is it to build some diversified portfolio that people can pseudo follow along with or get some construct out of?
I think with Drew's portfolio, it was about portfolio construction, educating on that. With mine, I just did an equal weight and I just wanted some kind of interesting talking points.
Yeah, okay, fine.
Well, I got XRF in there, which you'll be proud of.
Yeah, well done.
I got RPM Global, which you'll be happy with.
Yeah, it's good. And ResMed we talked about as well.
Yeah, ResMed, that's a goodie.
Okay, so look.
Mine is like a bit of a meh portfolio. Nothing's major in any direction.
Let's do something that's interesting rather than just... so why don't I tell you how to make the most money possible?
Okay, you tell me how to do that.
All right, so if you want to make the most money possible, there's 2 parts to the story. Number 1, you need to own as few positions as humanly possible.
Few?
As few. Little. Okay. So if you can find one great idea and put 100% of your money into it, that's ideal. If you're not confident for 1, do 2. And if you're not confident to do 2, you do 3. And you keep going until you're at a concentration that you're comfortable with, that you think that your win rate is going to be high enough to offset the ones that you're wrong about.
Okay.
If you're wrong at all.
Yeah.
Then you want to make the stocks that fill those slots as high impact from a expected return perspective as possible. Now, for each individual slot that you've got. So smaller companies with big catalysts inside your investment window. So if your period's a year, period's 6 months, period's 10 years, whatever it is, you need to be taking positions where you think you've got a big catalyst for change. So that's how you make the most money.
Mm-hmm.
The data, the research, investment research suggests, a portfolio of 20 to 40 companies is the optimal balance between concentration and diversification in the long run. So if you're being very sensible and you want to do things, that's how you do them.
Mm-hmm.
Or if you want to sort of think about it another way, 20 to 40 is enough diversification to tilt the portfolio far enough away from luck towards skill. If you want to use the luck-skill continuum kind of lens, we want to be relying more on skill and less on luck. Always a bit of luck, but we want our outcomes to be more dictated by skill, and 20 to 40 companies starts to get you into the realms of more of, much more reliance on skill.
Mm-hmm.
But if you're trying to make fast, short-term money like you guys are trying to do here with a year or whatever, is it a year?
Yeah.
Yeah. You'll need to be skilled, but you've got to accept that luck's going to be a much bigger
for sure, especially with Drew's portfolio. I mean, he's just guessing,
Well,
This is the community.
All of you are guessing, right? Like you're all guessing. We're all guessing. We're all playing guessing. The question is who's better at guessing. So, Drew's just...
He's gone sensible with a big chunk of his portfolio, though.
Drew's never going to win because he's gone too diversified, right? So it's like what if I was doing this with you? Like I'd bet you any money, small cap fund will beat all three of these over the next 12 months. No worries. Why? Yep. Because it's smaller. It's more like we've got more higher impact things. We've got catalysts for everything we know. I know what expected returns are embedded in the portfolio as well. But that being said, I just think that if you were going to do this, you'd want to be like maybe 10 companies at most if you want to make the most money. And you want to buy stuff that's, got expected returns of, like 20 to 100%. Why would you buy CBA? Look, it's not going to double. It's just not. It's not. Categorically tell you it won't.
Yeah, okay.
In the next 12 months. I can categorically tell you that.
What's it up?
Who cares? It's on 4 times price to book. Like it's not doubling. It's not going to 8.
17% for the year. Never would have thought that.
So I can categorically tell you Microsoft isn't going to double over the next 24 months. So I just think that you need to find, portfolio ideas that are going to really work for you. Now, this is obviously isn't just to shoot the lights out. Over on Equity Mates, Bryce is doing that 500 to 5,000 challenge, trying to 10 bag his money, and I've been helping him with that occasionally. And this is sort of like the Rask, much more sensible version. You guys are a bit more sensible over here, the adults in the room. So I think if you want to do, like, I can give you names for this, whatever, but at the end of the day, I'm just going to pick the 5 or 10 highest impact potential return things in our portfolio.
I like the luck spectrum, by the way, like skill spectrum.
Yeah,
it's a good way to put it for people.
I forget, there is a book I've read about this. It's very famous. If you type in luck skill book into Google, I'm sure it will come up.
Let's go.
Luck skill continuum book.
Continuum book.
There you go, success equation. That's it.
Success equation. Oh yeah, I've heard of it. Haven't read it.
Anyway.
Okay, no, that's good.
That's my thoughts. If you want to make money, you need leverage, and if you need leverage, you need concentration, and you need small stocks. Okay. And when I say small stocks,
you mean like ones with like growth potential, catalysts, that sort of stuff.
Ones where you can double.
Yeah.
Now you might think that Westpac's going to double over the next 12 months. You're an idiot. It's not going to double. So it doesn't have to. They don't all have to double. I'm just saying the point is that you can say, okay, I'm going to build a 10 stock portfolio. 33% is going to be a high probability of at least a 20% gain. 33% is going to be a medium probability of potentially a 50% gain, and then there's going to be 30, which is going to be more crap shooting stuff, which is 100% plus.
Sounds like a pretty wild portfolio.
Yeah, so that if you want to make money, that's how you do it. So yeah, I'm not saying people should do that or not do that.
Yeah.
But you want to talk about the way to make money? That's how you do it, and then get a really good hit rate.
Okay. Can I go through these portfolios and you tell me your favorite company in this list? Even if you don't own it, you just like the company. It's not a good investment. It's just you like the company. So this is the community portfolio. We've got SML, CBA, don't know what that is. Either global small caps.
You have to tell me what these ETFs
KKR.
are. I don't fucking follow any of that shit.
KKR.
Is it the company? Or
company. That's
Mater.
Mater.
Yeah.
I don't know what that is. QRI, I think it's like a real estate ETF. QSML is global small caps, I'm pretty sure.
Soul Patts and Vulcan. Yeah.
Soul Patts and Vulcan.
Vulcan have pissed me off recently because they're delaying and late.
What was the go with that finance thing recently? Did you see that in an announcement?
Yeah, they raised some money. It's just a fancy tied it up raising money. Just getting diluted more and delayed longer. So I would say Mater. I think Mater's good business.
You might have picked that.
Yeah, good business. Yeah.
Okay, let's go to Drew's portfolio. So he's got the 2 funds, which are boring. Microsoft, NVIDIA, Pro Medicus, the resources ETF from Beta Shares, ResMed, and Tesla. Tesla's down 24%. Can I tempt you?
Fuck, no. I'm better than that. ResMed? Yeah, ResMed for me from that list, for sure.
Okay, then this one will be a bit more juicy for you because it's got more Seneca companies in it.
Yeah.
FANG ETF, G-Gus Leverage, S&P 500. Home Depot, OZXX is just like Aussie X Financials and Resources. ResMed, RPM Global, Wesfarmers, and XRF Scientific. There's two.
Toss up between the XRF and RPM because we actually own both. They're both right up there in our portfolio. RPM's was a really big weight, and it's actually gone up a bit recently, so it's actually gotten real big lately. I looked at it this morning, and then XRF we think could report really well. I just signed up for the call.
XRF has ripped recently, like in the last few months.
I think it's $2 now.
Look at that! It went from $1.56 a month ago to over $2 today.
I hate to say it, but we bought stocks so well in that. We were like, we had less, and now we took it to number one position in the portfolio at about a month ago.
Really?
Hate to brag, but I did.
Well done, good sir. Well, that was because they kind of like had a bit of a softer report there for a while. People freaked out a little bit.
Full shit they did. I disagree with that.
Well, maybe that's all the good research members.
I disagree. I hope it is. The good research members will know that XRF got a pre-reporting season write-up only maybe 3 reports ago.
Yeah, right.
So 6 weeks ago, we wrote up something. So yeah, I think
you're pretty happy with that.
They would have got a nice little roll in there.
Yeah. Okay.
So,
cool.
Yeah.
So with good research sold out,
what's happening?
Yeah. So you're now focused on, obviously, which you always were, but which you're focused on is the small companies fund.
Yeah, small companies fund. Rest of the business, continuing to do all the other stuff as well. But yeah, I mean, good research. The wait list is there. I think there's like 75 people on the wait list.
Oh, really?
Yeah. So
wow, man.
If we're only doing the annual now, $5,500 a year. I told you I was going to put the prices up. They're up. So no more monthlies. Annual now, $5,500 a year. If you get a slot, or if a slot becomes available and it's your turn in the wait list, you'll get an email. It'll give you 24 hours to take that slot, or you're off.
Okay. That's fair enough.
And we move on to the next person. So, I think we've had one position come available in the last, and that's been taken up.
Yeah, right. So that's good. Well done. Goodresearch.com.au. What about the fund? How's things going?
Fund did 2.5 roughly for June. It's done 25.9 or whatever for the year. 13, 14 ahead of benchmark. After fees, it's open to wholesale clients. You can apply on the website via the Newport Asset Management, our fund administrators portal. It's going well. It's got really. I'm always putting more money in. I put more money in every month, pretty much.
Well, it's bonus day tomorrow, isn't it?
It is bonus day tomorrow at Seneca.
Yeah, and does that mean you're going to tip more back in, or what?
Yeah, I think so.
It's going well.
Business as usual. Just keep plugging away. Large cap's been going really well last couple of weeks, which is good. Like CBA starting to underperform, so that's kind of
a weight off.
Yeah, like rationality starting to prevail, which is kind of good. So that's I'm pleased with that. That had a good day today. Still got a lot of catalysts in the pipe. Embedded value, like we always look at embedded value in our portfolio. So where we think it kind of is a good predictor of where returns are going to go. It's about as good as it's been. So people are like worried about, have I missed the returns? It's like, no, we're doing this stuff for years. So really, really pleased with the business at the moment. It's
congrats, man.
8-year overnight success story. But yeah, enjoying it and. Yeah, it's good fun.
Yeah, Benny's enjoying it over there in Europe by the sounds of it.
Yeah, he's on a rock in Greece somewhere with his... Oh, he might be actually on the way back. Oh, not quite. In a couple of days. He's back at work on Monday.
Yeah, right. Better get those tips coming in before reporting season.
It's time for me to go on holidays.
Yeah, you need it, my brother. Well, hey, thanks for coming in, reviewing the portfolios, having a bit of a laugh.
Mate,
it's always good fun. I'll get Twiggy's secretary to give you a call after this, mate, after Twiggy, those comments.
I'm just looking for a pair of R.M. Williams, mate. Couple of mil that he's got hanging around.
Yeah, that'd be fine.
Help me retire. Knock off this mortgage quickly, and we'll be good.
No, good, mate. Well, Luke from Seneca Financial Solutions, mate. Thanks for coming in.
Thanks, Rasky.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.